up as a public investment manager at Wasatch Advisors, managing a public mutual fund. And most of my career, I ran the Ultra Growth Fund, which, focused on small, rapidly growing public companies. So I managed that product for over a decade. And after .com, I became concerned that some of the most exciting small growth companies would stay private longer. And I think, I had no idea how right I would be. I think I was directionally correct, but would have never guessed the magnitude of the shift. And as you know, companies stay, private about 3 years longer now, and generally exit, at much larger valuations, usually in the billions, sometimes tens of billions. Versus they used to come public in the 300 to 500 million range. So that's really what drove my shift to venture, was to kind of follow the companies I've always loved investing in. And now those companies are late stage private companies instead of small and micro cap public. So I formed Cross Creek as a wholly owned subsidiary of Wasatch Advisors to invest in these late stage private companies in 2006. And, we added a fund of funds program after a couple of years to really give us better visibility into all the companies that venture capital is creating at the earlier stages, and then be able to co-invest at the later stages. So that's kind of the history of Cross Creek. And we became a separate entity in 2012 from Wasatch, but we still have a very close working relationship. So that's how I became a venture capitalist, which is a pretty unusual route, I think, to venture.
Maybe.
We really first started making these investments, right after .com, but we were making them through the mutual fund that I was running. And at that point, the VCs were extremely welcoming to a late stage investor. After .com, a lot of the portfolios were under reserved, and the IPO markets were very difficult. And so the possibility to partner with a public manager that wanted to help some smaller companies get public maybe earlier than the VCs expected was a very positive story. Most of the public funds were not making any private investments, or really were not active in this field. So we were a very unique beast at that point. So I think the initial reception was excellent from the VCs, welcoming us to invest in some of their later stage companies and work with them to take those companies public. I think, obviously it got a little more competitive over the years, but then we got hit by the recession in 08 and 09, and, we're sort of back again to, IPO markets difficult, late stage rounds, fairly difficult. All that's really changed lately. A lot of the larger public managers are quite active. Many of the traditional early stage VCs have created opportunity funds that focus on funding, their earlier companies in those later rounds, so they often have the capital to lean into those, what we call crossover rounds, where, historically they just didn't have the fund reserves to do that pre-IPO round that was, much bigger than they ever expected when they launched these companies, because they were staying private longer. So there is a lot more competition, a lot more activity, but to offset that, the market is so much larger, because, I think this year we're on track to have over 200 companies, that are private companies that raise rounds, and they're generally large rounds, hundreds of millions, at $1 billion greater valuation. So, back when we started, that was extremely rare, less than 10 companies a year, typically raising, venture-backed companies a year that were raising $1 billion plus valuations of private companies, so while there's certainly more players in this market, the market has expanded, exponentially. So I think there's a lot of room, for capital in this market. And the big picture is the private markets have just taken a large piece of market share from the small cap public markets. So, there's room for a lot of folks to play in that extra 3 years private. So the companies we're investing in, our average company is, well over 100 million in revenues. So these are real companies. Some of them are profitable. All of them have a clear path to profitability. They've figured out their business model. They've got good unit economics, and a lot of them are spending a lot on sales and marketing to grow rapidly. Typically the companies are growing, 30% or much higher. But they're companies that clearly would be profitable if they were to slow their growth rates. Some are growing 100% plus, and that often brings you into the red. Our typical profile is a company that we think can do a high quality IPO in the next 2 to 4 years. Some even sooner, but definitely less than 4 years. We're currently averaging about 2 years. So that's the kind of company we're looking for, a mature company with a proven business model and what we call a streetable management team. And what we mean by streetable is they've got the team in place to take the company public, or at least for the most part. Maybe we're missing a public experienced CFO, or maybe there's a role missing, but we think it's a team that's ready, both in terms of the quality of the management team, but also the financial reporting and all the other, metrics. Really important one for being public is the predictability of revenues and earnings when they're public. So we're looking for those companies that are really ready for us to help them become public companies. And the majority of our exits actually are IPOs, which is pretty unusual for a venture fund. I think across the board, about 90% of venture exits are M&A. Even at the later stage, it's still a majority of the companies get acquired. For our total exits, the majority of our exits are public, and many of the companies are prepared to go public but still get acquired. But our companies really are on IPO track. Well, we have a separate program for investing in funds, and we really created that because I grew up in the public, markets where everyone has access to every publicly traded stock. I mean, if you have a Bloomberg or some similar system, you can be the newest kid on the block, but you can invest in any public company, and you basically have all the same information. Maybe you have a little harder time getting access to the management meetings, but the calls are public. Because of the regulations, you really have almost the same access to information and the identical access in terms of your ability to purchase a public company. The private markets, of course, are completely different. It's a private business. It's very clubby. There's no Bloomberg. There are some databases with companies listed, but to get access to understand which companies are really IPO candidates and getting to our late stage, and to not just identify them, but to get an invitation to meet with them and potentially invest in the company, is all controlled by the earlier stage investors. So what we've built is really a partnership with what we think are the leading venture firms, to get to know their portfolios. We invest in those funds, get to know their portfolios, and then we really want to partner with them on that pre-IPO round for that small portion of companies, that are on an IPO track. So what we look for is we generally invest in the medium and smaller venture funds. The largest funds have a tremendous amount of capital to fund their companies all the way to the IPO. But the medium and smaller funds that have proven track records, obviously we're looking for great returns from those managers, but also opportunities to co-invest. So that's the profile, and we invest across sectors and geographies, although primarily US and Europe. We're not doing emerging markets or a lot of those markets where venture is just a bit less mature. Well, first off, I think there's a big misperception about late stage valuations. Venture capitalists tend to see valuation as the average enterprise value for a seed round, A round, B round, and they look at this sort of D plus round and say that valuation has gone up dramatically. That's true, but the revenue scale, just the size of these companies has gone up dramatically too. Remember, these companies are staying private for, on average 3 or 4 more years. And so these companies are bigger, more valuable companies. And so, the multiples of revenues and the multiple of EBITDA, for those that are profitable, I mean, those metrics matter. I mean, as a public investor, you would never look at a public company and say, oh, the average public company's, higher than it used to be. It matters on the multiples of what those companies are. So I think that's a big misperception. These are just different companies. So, the traditional last stage venture round, I would say it's above its historical valuation range, but this average enterprise value of these rounds is really going up because it's a whole different group of companies. We call them pseudo IPOs. These are not your traditional late stage venture rounds. These are in fact replacing the traditional IPO. And those kind of valuations are, normal for public companies. In fact, the companies we invested in the late stage, our average sort of revenue, the percentage of companies that are profitable, the growth rate, the companies we invest in look almost identical to the average IPO last year. So, these are really IPOs, not late stage venture profiles. And that's why the valuations are higher. They're just different companies. In March, we put together a presentation for our investors, and with the market indexes down 20 to 30%, we all assumed that the IPO window would slam shut, as it usually does with that kind of market correction, and be shut for 12 to 24 months is sort of the historical norm. So we were prepared for that, and we were looking closely at our companies to make sure they were funded. And those that were planning to go public, had other sources of capital if they weren't going to go public. And of course, I think everyone was stunned. I don't think I've read a single sort of market, pundit out there that expected this quick of a rebound. And, the market not only rebounded very dramatically, as you know, but by summer we were in a white hot IPO market. With not only a large number of IPOs, but really, strong pricing and first day trading. While some of those have stabilized a little bit. I mean, the IPO market's just been very, very strong in the year. And of course, many companies in February, March, when the market tanked, they put their IPO plans on hold. And so they weren't prepared. It's a big lift to get a company ready to go public. It's the financial reporting, the SAR box, hiring bankers, and the SEC process to file your documents and get them reviewed is a long process, and a lot of companies sort of slowed things down. And I think that really created an incredible opportunity for these SPACs, because they're able to go public very quickly because there's not a company underneath when they first come. It's a much easier offering from a regulatory and accounting standpoint. And then they can buy some of these companies that didn't finish the process to get ready. So not only do we have a super strong IPO market, but many companies that wanted to IPO and had put their plans on hold chose to come public through the SPAC market. So really not what anyone, I think, expected in March. I don't have a crystal ball. I mean, nobody does. I think that some people have said, a lot of the good companies have come, and I just disagree. I think there's a very strong pipeline of IPO candidates right now. There were companies that certainly did put their plans on hold and didn't choose a SPAC. I mean, there was a lot of companies that were thinking of coming this year that didn't. I think there's a very strong pipeline, and I think if you talk to any investment bankers, they've got a very strong pipeline of candidates. The question is, how will the markets look? And anybody, nobody knows, what that window will look like. But I think there's a lot of companies preparing, and if the markets are willing, I think we could have another very strong IPO market in 21.